Bank regulators have vowed to improve their supervision of banks after the recent failures of two lenders, Signature Bank and SVB Financial Group. The Federal Reserve and the Federal Deposit Insurance Corp. have issued reports saying that the bank's managers were primarily to blame for prioritizing growth over risk management. The reports also point to inadequacies in regulation and supervision by the regulators themselves. The Fed's report indicated that the examiners did not appreciate the problems at SVB and failed to escalate certain deficiencies. Meanwhile, the FDIC report revealed that the regulator could have acted sooner and more forcefully to compel Signature's management to address liquidity risk management and over-reliance on uninsured deposits. On April 28, it was reported that American regulators warn big banks that they will face stricter monitoring following the recent failures of Silicon Valley Bank and Signature Bank due to supervisory oversights. This announcement was made by the Federal Reserve and Federal Deposit Insurance Corporation. Despite the fact that the banking industry has generally stabilized since the aforementioned failures, their widespread impact was still evident on Friday as an even bigger financial institution, First Republic Bank, was on the verge of collapsing. According to an individual familiar with the matter, regulators were getting ready to close down First Republic Bank, which is based in San Francisco. The bank had lost $100 billion in deposits as panicked customers withdrew their funds following the collapses of Silicon Valley Bank and Signature Bank, which had put First Republic's survival in jeopardy. The Federal Reserve's evaluation of their shortcomings in recognizing issues and advocating for solutions at SVB, which is located in Santa Clara, California, included commitments for more rigorous oversight and stricter regulations for financial institutions. In a letter that was attached to a 114-page report, which included confidential documents that are usually not disclosed to the public, Fed Vice Chair of Supervision Michael Barr stated that their initial priority will be to enhance the pace, strength, and flexibility of their supervision. The report indicated mounting concerns about the bank's insufficient risk management, but revealed that there had been little action taken to address these issues. Barr also indicated that they plan to implement regulations currently reserved for larger financial institutions on banks with over $100 billion in assets, as it was observed that increased capital and liquidity requirements would have strengthened SIB's ability to withstand the collapse. Our experience after the failure of SVB showed that it is necessary to apply stronger standards to a more extensive range of firms, Barr said. In addition, the FDIC provided a 63-page report that outlined its shortcomings in the downfall of Signature Bank, as well as the management's failure to rectify ongoing vulnerabilities in liquidity risk management and excessive reliance on uninsured deposits. Both SVB and Signature Bank collapsed in the previous month. The FDIC acknowledged that it could have acted more promptly and with greater determination to compel the management and board of Signature Bank to more rapidly and comprehensively address the deficiencies in their operations. In hindsight, the FDIC could have taken earlier and more decisive action to prompt the bank's management and board to more quickly and thoroughly resolve these shortcomings, the report stated. Both reports attributed the collapse of SVB and Signature Bank to their managers' primary focus on expansion and disregard for fundamental risks, which ultimately paved the way for their demise. The FDIC report did not specifically name Signature Bank's ex-CEO Joseph DePaulo, but referred to him as the individual who dismissed the examiner's concerns about uninsured depositors on the day of the bank's run on March 10. In contrast, the Federal Reserve report mentioned former SVB CEO Greg Becker only once, in reference to his position on the board of directors at the San Francisco Fed. Prior to the simultaneous collapses of SVB and Signature Bank in March, banking regulators had directed most of their attention to the largest American banks, which were viewed as crucial to maintaining financial stability. According to the report, this emphasis on the largest banks was partly due to new tailoring regulations introduced in 2018 by Randall Quarles, the Fed's previous vice chair of supervision. There was also a change in expectations for supervisors, who were expected to gather more evidence before taking action. Fed personnel claimed that they were under pressure during this time to alleviate the burden on banks and show due process. Senator Tim Scott, the leading Republican on the Senate Banking Committee, referred to the weak response by examiners as a clear failure of supervisory culture. However, he cautioned against reinstating stricter regulations that he believes would penalize well-run banks for the unique failures of their competitors. Scott is a potential candidate for the 2024 U.S. presidential race. According to Greg Baer, the president and CEO of the Bank Policy Institute, the Federal Reserve's report places responsibility on recent changes to regulation and supervision, despite the examination team's fundamental errors during that time. Eric Compton, a banking analyst at Morningstar, noted that any modifications would provide banks with ample time to adapt. He also stated that many investors were concerned about the regulators imposing strict measures on the entire banking industry abruptly. According to the Federal Reserve's report, the supervisors at Silicon Valley Bank (SVB) failed to fully understand the problems at the bank and did not properly escalate certain issues even after they were identified. The report revealed that at the time of its collapse, SVB had 31 citations on its safety and soundness that remained unaddressed, which was 3 times more than its peers in the banking sector. The citations included issues with interest rate risk modeling, which examiners had directed to be resolved by June 2023. The rapid growth of SVB and Signature, outpacing regulators' ability to keep up, was a significant factor in their failures, according to reports by the Fed and FDIC. The reports also criticized the bank's management for prioritizing growth over risk management. The Fed is considering tying prompt fixes to executive compensation to ensure better compliance from management. Both banks had significant deficiencies in their safety and soundness, which regulators failed to address adequately. The FDIC's report on Signature highlighted poor management and a pursuit of rapid, unrestrained growth as the main causes of its failure.